it just became a headache. And this is only with 11 rental properties. And I realized it wasn't scalable. And when you become an accredited investor, the wealthy start to realize it's not really about cash flow per se, but it's more about net worth growth. I didn't like my day job and I wanted out. And then I started to realize, like, wait a minute, if I just rinse, wash, repeat, did this a few more times,
Right.
I'll be able to escape the rat race.
We know all real estate agents want to acquire clients consistently so that they can grow their business and income for that great lifestyle. This broadcast brings you the best and top people in the industry to support that quest. This is Dave Finalli, and I'm here to bring you the Real Estate Skill Builder broadcast, Real Estate Talk TGIF, brought to you by Real Estate Skill Builder and Align, your premier real estate solution. Welcome, everybody. Again, this is Real Estate Talk TGIF, episode 417. We love doing these every week, and we've been going on. It's almost 8 years every week in a row. And today, our guest is very, very special. He just didn't climb the wealth ladder. He actually built an entirely different ladder for himself. After 12 years as a licensed professional engineer, Lane looked at the traditional work harder, max out at your 401k and all this other stuff. So he decided that the whole system was broken, fired his boss, started with one rental property, made money for getting deposits to buy more, did a lot of different things in real estate as far as investments concerned, built a portfolio of cash flow investments across the United States. Today, through the Wealth Elevator, he teaches high-income professionals and everyday investors how the wealthy actually build freedom through cash flow, tax strategy, and private investing. Lane believes true wealth isn't about looking rich. It's about owning your time, controlling your life, and having the freedom to choose how you live. Please welcome everybody, investor, educator, and the author of The Wealth Elevator, Lane Kawaoka. Welcome, man. How are you?
Hey, thanks for having me again. Appreciate it.
Good. Well, let's have some fun. And we always get started with a real fun question. Everybody, I ask this question of everybody else, and it's Real Estate Talk TGIF. The question I have for you, Lane, is really simple. What does TGIF stand for?
Thanks goodness it's Friday. I can actually work on the projects I want to, work on without answering that many emails or outside requests.
I love that. And what I like about TGIF, the actual 4 letters, is that it has a lot to do with this broadcast. And when I named this broadcast 8 years ago, I didn't know it would stand for this, but it actually stands for you. You were right for you. For me, it's thank God it's finale. So, I mean, I'm really happy about that. So we're going to have fun with that. Anyway, man, again, thanks for being with us. You're completely totally on the investment side, how you gain freedom in life by doing investments. Started as an engineer, civil engineer. Tell me your journey, though. I mean, something clicked in you through time being an engineer about real estate and stuff. And you were actually in Seattle, Washington, where you started. Talk to me about your journey, man.
Yeah, I mean, I kind of started on this, what I call the linear path that a lot of folks are on, that I was on. My parents told me to go to school, study hard, became an engineer, had a good paying salary, right? But up to this point, you're always taught to do the 401k, buy a house to live in, which I don't necessarily think it's the best for some people out there. Most people, it's a forced piggy bank. So for them, it's good. But for people who are good at saving their money and making good money, it's probably better to invest.
Right.
In not necessarily in real estate, but to invest.
Right.
But yeah, getting back to my story, started as an engineer and I saved up. I was a good saver with my money. So able to save maybe 30, 40 grand right out of college every single year from my paycheck after expenses. So I saved up 80 grand to go buy that $150,000 house to live in. But because I was traveling all over for work, as a lot of young professionals are, I was never home. Right. So just started to rent it out. And that was where I got the taste of cash flow and, never looked back since.
Okay. So you started, you started buying properties as you saved money for down payments, right? So how did you decide what your first property was going to be?
Something that looked cool that I wanted to live in, right? So it was absolutely the worst rental property. It was a class A rental in an A- area. The rent to value ratios weren't really that great, but luckily this was back in 2009. Right. Almost a couple of decades ago, I suppose. But just got started. And then I started to realize, like, whoa, this is cool. Like in the beginning, it was like, wow, this is just a nice little beer money in the side, like what, 400-500 bucks a month. And then I started to realize, like, wait a minute, if I just rinse, wash, repeat, did this a few more times,
Right.
I'll be able to escape the rat race. And then I got really more like started to devour all the books and podcasts out there. And there's a lot of stuff that we'll teach in our podcasts and like what markets to buy in, stay away from the blue states, right? And here I am in Seattle, right? One of those worst places for that. And then also, one thing I started to realize is like, well, I bought really on the high end. I bought something nice that I wanted to live in. It's not necessarily the best place for cash flow. So that was kind of where the next property I bought, it took me a couple years to save up for the down payment
Right.
for more of a duplex, more of a B class rental property, to get a little bit better cash flow and rent to value ratios. But yeah, soon after, the prices started to come up. This is around 2012. And, I was kind of pushed out of my market, but then started to buy properties out of state. Eventually got 11 properties by 2015 in Birmingham, Atlanta, Indianapolis, and, sold off those rental properties. And in that, I would call it like we call it primary markets, right? Seattle, Hawaii, California, places with the higher, with the worst rent to value ratios, but cool places to live, but definitely don't have as good a cash flow as some of these flyover states.
So you weren't focused in on cash flow. You were more focused in on something else. Explain that.
I mean, I wasn't really focusing on anything initially, right?
Right.
But
Right.
I suppose the goal did transfer to cash flow, and I'll get to like today. I talk to a lot of my clients, and I look for myself. Like I think that's a bit of a mistake. People say cash flow is king. Whatever, right? But at that time, I was in a bit of pain, right? Like I didn't like my day job, and I wanted out. So the obvious solution is, well, get as much rental properties or assets that produce enough income for you on a month-to-month basis so you can quit your day job. Um, that is very nearsighted and a very common goal of people under $2 or $3 million net worth. When you go above $2-3 million, you start to realize, well, I probably have a pretty sizable portfolio. Hitting my monthly nut number is pretty easy, or I should be able to manufacture that by selling something or taking a loan off something. Doing that would be the tax-free way of doing it by taking a loan off of one of your real estate or your security-backed line of credit, something like that. But the wealthy start to realize it's not really about cash flow per se, but it's more about net worth growth.
But okay, so there's two things in there I want to talk about, right? So it's more about net worth growth and cash flow. I'm going to get back to that, but the first thing I want to talk about is you said you didn't like your day job and you wanted out. So look, some way, somehow, you decided to be a civil engineer. Was there, and this is like a loaded question, was there like a passion to be a civil engineer, or was something that seemed cool for you at the time? I'm getting to a point here, believe me, I promise.
No, it was not passion. There's nothing passionate I do these days. It's all money and numbers. I know I can recall when I was a teenager going on Google when Google was like a new thing, I
Right.
guess back then. And I was like, I was trying to solve the problem or the question, like, what is the least amount of college I can go to in grad school? I didn't want to do that. Certainly didn't want to get a doctorate. Where I can just be 4 and out and get the highest salary right out of college. And when you do that, it's all the engineering, right? So that was kind of the direction I headed.
Okay, so you just it was all about cash flow, all about cash, all about money. So how did the passion for real estate start? I mean, being a civil engineer, you're working, you're working with the land, you're doing all that. That's the type of engineering it is. Is that where you started seeing different things? How did the passion had to grow somewhere? Again, was it money?
Yeah, I mean, I think the passion is just trying to grow the number, and it's kind of like playing pinball and just trying to get the biggest score. I mean, I can't really say I'm super passionate about real estate. I mean, I don't really get jazzed over like redesigning or renovating units and stuff like that. I mean, the stuff we do is more of apartments. It's commodities. It's kind of turn them and burn them. Same thing over and over again. But I like the results that it gets.
Well, you like the
Right.
results of the money, correct?
Right. Like I don't really
Okay.
like lifting the weights every day, getting up early for that. I just like
But
the
you like the
results.
results.
It's kind of that thing.
Understand that. So it's like, yeah, I get that 100%. And that was a really good analogy to use, a really good example. Okay. So talking about the passion for growing money, you decided, as I said in the intro, you built your own ladder, your own elevator for this. Tell me the process that you went through to get to where you are now. What I mean by that is you got into civil engineering because it was going to be a good money business for you to be in, a career to start to make money. Real estate, you saw a way to build wealth, not make money. So you built an author, the Wealth Elevator, which is a book about growing wealth. So talk to me how you went from doing all these things. Is this a process of what you did and how you did it?
Yeah, I mean, everything I put in the book is an experience share, right? And what I realized, I mean, first thing that was frustrating was like, there's really no book written for the accredited investor, right? Person $1 million net worth or greater. There's a lot of books, Dave Ramsey, Caesar Orman, that are written more for the lower net worth individual in debt, right? Like in the book, in my book, there's different floors to the wealth elevator, or this proverbial analogy of a building. In the basement level, those are the people with $500,000 or $500,000 income a year or less, in barely any net worth. I was lucky enough to start on what we define in the book as the first floor of the wealth elevator. So non-accredited investor, you make a good salary, but you're still kind of in the come up years. Now, this is where I was from 2007, graduating college, to about 2014, 15 is when I kind of crested over $1 million. So, but in this stage, to me, the name of the game is obviously grind and work hard at your income producing job, or if you're a realtor, but you want to be buying little rental properties on the side or other assets, right? So this is what I did. Building up to 11 in 2015. This is where I realized, and part of this was like my own journey, like meeting other accredited investors at this point, started to realize that they invested very differently than the non-accredited investor. They're actually trading in their little rental properties. And at that time, we call them headaches, right? I mean, they're great. They're a few $100 of cash flow each. Who doesn't want that? I had 11 of these things at a few $1,000s a month. I'm not complaining, but that's not, most of my clients need like 10 to 20,000 per month. And I was having maybe an eviction or two every single year, some kind of big catastrophe that happened every quarter, like a tree fell on the house, washed out in the basement. I mean, I had professional property management to do all my dirty work for me because I'm working my full-time job, or I'm betting a lot of you guys are, very busy, active agents, running your business.
Yes.
But it just became a headache. And this is only with 11 rental properties. And I realized it wasn't scalable. And when you become an accredited investor, your net worth is a little bit more of you need to protect that, right? You're much more of a target on your back for stupid, silly lawsuits. And thus the reason to move more towards an LP position in a larger commercial deal makes a lot of sense. But this is kind of that second floor of the wealth elevator that I'm kind of talking about here. At some point, there's a pivot. We can talk about the rest of the floors later, but just this kind of just setting this thing up. Like these are a lot of the stages I've been through, and I started to realize out there, I got really frustrated, especially lately with everybody like with zero attention spans, listen to like YouTube shorts and TikTok, right? The short videos. Like there's a lot of financial advice here. I'm sure people's feeds, if they are even on those mind numbing like channels, like there's a lot of stuff coming through there. But at what point in the wealth elevator journey, what floor you're at, does it actually pertain to you? Right? Like most of my clients are a few $1 million net worth or greater. They don't the $5 latte or $6 latte trick is silly to them, right? But again, there is not a book written for an accredited investor, and that's what I kind of sought out to write. And then they got the Rich Dad Poor Dad book, but that's very esoteric, right? It's buy assets, right? But at what point do you step up from the small deals to the big deals, right? That's what we kind of talk about.
So let's bring it down to the first floor and talk about the basics of investing. You mentioned something about blue state, red states earlier. Talk to me about that a little bit, because when we're talking about investing, you were invested in other states and you were able to do that virtually to a point, correct? But you had to pick where you were going to invest. Talk to me about that.
Yeah, I mean, now, and we're not allowed to talk about politics here. I actually agree with that rule, Dave. I think it's a waste of time to talk about stuff because people are going to have their prejudgments and stuff like that. But
yeah, the question basically is, why was one state better than the other? Why, like, for instance, you went to a couple of different states on the East Coast. Talk to me about that and why they were good.
Yeah. So what I was getting at is, certain states have a better legal system, or it's weighted in favor of the landlord more so than the tenant. Just typically, your blue states are going to be more favored toward your landlords. And not saying that it's wrong. Like, I live in a blue state. I've always kind of lived in blue states. I mean, they're great, right? But when you're the landlord, you don't want to have your property in a blue state under that jurisdiction. Additionally, this is why we've kind of focused on more of the red states. In addition to that, the stuff that we focus in on, we cater towards the lower middle class, right? That's my investment thesis. The hardworking blue collar guy who's paying $800 a month to $1,200 per month for an apartment. Maybe a little bit more for a single family home house. We don't do that these days, but this is, the reason why is this is the glut of America's population. If you think of a bell curve, and one of the reasons is the whole narrative of the rich are getting richer, the poor are getting poorer,
right?
And the poor middle class, which I believe I was, and a lot of you guys listening, if you don't do anything, you're gonna be the lower. You're gonna slide downward, right? And thus, we got apartments for you guys to rent, right? Or those people to rent, and that's where I realized, like, well, most of these like red states, they typically have a little bit more stronger economic drivers that are a little bit better for the lower middle class, the masses,
right?
And so from that point of view, that's also a reason why we kind of favor some of these red states more than others.
So my background is basically all in investment properties. When I started, did own my own brokerage for 21 years, but it was all prior to that and after that, it was all about owning investment properties, apartment stores, mixed use properties, etc. And knowing that the laws, like I'm in New Jersey, right? And everybody knows I'm in New Jersey, right? So one of the things we have to understand about the state of New Jersey is there's really only one way to get a difficult tenant out, to get any tenant out, and that's non-payment of rent. Without question, you go to and my favorite judge was the judge that said, "Do you have the money to pay Mr. Finalli today?" He says, "No, I don't." And his next question was, "Do you have a place to stay tonight?" So, and this is the only way in the state of New Jersey where you really can get people out. I mean, there are a couple of other specific and intricate ways. But the reason I mention this is that it can be very difficult to be a landlord if you don't understand not only the 2 a.m. calls and having to fix a toilet, whatever it is, but it's also there will be from time to time difficult tenants. As far as a landlord base is what I was, is my objective was to bring in the right tenant. And you can only do that if you're doing it hands-on. And it's difficult to invest, through all different states unless you get the right management company doing the work. My objective was always to bring in the right tenant that was not going to be a pain in the ass, which meant my rents were going to be a little bit lower, and I kept them a little bit lower so that I was able to do that. Why am I saying all this? Because it's important for people to understand if they're going to invest, they have to have an open mind to their tenant and where they are and what the laws are, as you just stated, right? Understand how your state works. Understand, if you have a difficult issue, what you have to do for it. And bottom line is, does it make sense for you to hire someone to do the management for you? Moving along now, we talked about where you're going to buy in these states. Neighborhoods are important, are they not?
Yeah, so what we'll do is we'll grade the neighborhoods, right? And also the property. So I'll go to the neighborhoods first. Like, you have your A, B, C neighborhoods. Typically your A neighborhoods are going to be places where we all want to live, obviously. But the rent to value ratios aren't going to be as strong in those areas, right? Because you're competing with other homeowners there. On the same side, like, you've got like the class C properties, and you can get into war zone areas. Like, I mean, we had some properties when we first started in these areas,
Right.
but
Right.
it's just a difficult clientele. Like from a numbers perspective, we had several of these in like Texas, and I think that the collections were like 80%. So what that means is like you might have 100%
Wow.
occupied.
Only 80%.
Yeah, I mean that's sometimes it's worse, right? So if you have a 200 unit apartment complex, and 99, it's 90% occupied, so it's 180, people in there, but of that, only 80% of people are paying. I kind of work. Maybe I'm not the best at math, right? I'm good at
No, you
spreadsheets,
you
but
you did
you
fine.
got. I think what is that? You've got like 160 people paying, right,
Yeah.
at the end of the day. So I
Yeah.
mean, some people call these folks the deadbeats walk, right? But on the P&L, that's just your bad debt that you got to write off there.
Right. Right. So, as people are getting ready to buy investment property, whether it's that two-family house or a 10-unit apartment building or a 100-unit apartment building for all that matter, they want to look at, how the numbers work. For me, it's like my dad was an interesting type of investor. He knew that if it paid for itself, it was a good investment because it was going to go up in value. Because I know he didn't make it up, but he always said, land, they ain't making no more, right? So he knew that, and that's how he ran his. He never ran a number. He just saw that if it was going to bring in X, and he had to pay Y, and it was just 5 plus or less than X, he was able to do it. But now people try to get as fancy as possible using phrases like cap rate. I have found in my experience that mostly anybody that comes to me right away that says they're an investor that uses the phrase cap rate, the term cap rate, most of the times they don't know what they're talking about. For me, I look at yield. To me, yield is if I use $100,000 in cash and I'm going to get $10,000 of cash flow at the end of the year in net, my yield is 10%, right? So I have a certain desire of what yield I want when I go into it, and I try to do all the work to figure out what my best and worst possible yield will be. Talk to me about your process, how cap rate comes in, and do you agree with me about most people don't know what a cap rate is?
Yeah, I mean, it's two-sided, right? Like, I mean, if you're working with sophisticated people, I mean, you talk about cap rates, and
Right.
reversion cap rates, that type of stuff. But I would agree with you. Like most people who don't own 1,000 units or greater, they're kind of using the term cap rate as like what the broker gave them as the cap rate.
Right.
So
Right.
so maybe I'll just explain that. It's like when a broker's trying to sell the property, and you never listen to broker, right? Well, sorry guys, I guess you guys are all
Right.
brokers,
I
but like
agree.
especially on the commercial real estate side, like you never listen to them, right? Like if they tell you, oh, this isn't a B class area, it's a crappy C class area. You just always, whatever the broker says, you always take it with a lot of grain of salt, right?
Right.
So
Right.
one thing the brokers are always saying, especially on the commercial side, is like, hey, this is a 5.5 cap, which means what they're trying to say is like, well, if after you strip out all these things, you're making 5.5% on your money without debt service in there. The problem is, like how they came up with that is through a pro forma, right? Which is a
Yes.
profit and loss statement where you have all the income and all the expense line items. And if people want, we have like a free spreadsheet that people can play with. They go to thewealthelevator.com/turnkey. You can just download it. You can see what I'm talking about. But the problem here is they're just fudging the numbers, especially on the expenses side, to inflate that ratio or the cap rate at the end. So it's just all BS anyway. So you as the consumer, or the buyer might as well just like not even pay attention to it, you know? I mean, it's like online dating, like everybody puts the best statistics out there and catfish photos. It's the same game, right? Just know it's a game and you got to play it. But
I
like,
agree with you. Yeah.
I mean, what we'll do is like when we, whether you're buying a single family home or like a 300 unit apartment complex, like what we take in is the raw financials. So the T24, T12, which is the trailing financials from the last year or two. And you put it, this is what underwriting is. You take in the raw financials and you kind of line it up with the rent rolls to verify things. But you take that and you've got like a good run rate of what the income and expenses are. And then obviously the delta of that is the net operating income. And then from that, you're kind of being a detective and you're looking at all the expense line items for like landscaping, maintenance, trash removal, like every little thing. And this is where experience comes in. But, like from a high level, right? Like, these days, a class B apartment that you might buy for 100, 150 grand out there per unit, you can't run that thing for under $5,000 a year in annual expenses. So that's like an easy spot check. If you guys are ever looking at syndicated commercial deals, I would probably argue that you probably need to be more like 6,000, 7,000 plus per year.
Are you talking about per unit?
Per unit. Unit.
Okay. So is that a rule of thumb that you use? Is that your guideline that you use between 5 and 7K per unit?
Yeah, I mean, people always say like these syndicators, they always say like, oh, we look at 10,000 deals a month. I'm like, that's silly, right? Like, I mean, you're heuristically throwing out garbage deals that don't even make sense. And yeah, one of the top one is like if it doesn't even hit a certain cap rate or yield initially, you throw it out. And now you're down from a 10,000 down to 500, right? Now from there, now you're looking at certain things. Like sometimes, like especially on the smaller buildings, the previous seller may be self-managing it. They may not have a property management line item,
right?
Which is huge. So they could be showing this thing at like 5,500 annual expenses per unit, but there's no, they're putting in sweat and tears, and they're not paying a third-party manager, which is how we want to run it, right? We don't want to run it with bubble gum and masking tape, duct tape.
Yeah.
So when you got to reinsert that because that's how you're going to run the business.
Right.
And then obviously then the cap rate comes way down and that net operating income comes down and it just doesn't pencil. But what we'll do is we'll get it to a point where we're only looking at a handful of properties a month or even a quarter. And then we'll go with the fine-tooth comb. Well, actually, what we do is we'll employ out third-party underwriters to do a lot of like the heavy lifting, but we won't get them involved. I won't pay for these guys to do their work until like we kind of gave it the old thumbnail and got rid of 99.9% of the garbage deals out there. But that's essentially the process that we follow. I mean, essentially what we operate as is sort of like a family office. Right. So we're bringing in deals from our sources. None of the, a lot of these guys are more family office type of institutional level. And so our deal sources are, better than your average, real estate guy under $1 billion of acquisitions. But then run it through, get the P&Ls and financials and run it and underwrite the deal and, apply. What I teach a lot is, for accredited investors, like how do you look at a syndicated deal and know that the numbers they're using are sound, right? Because really everybody out there, I mean, again, using that online dating analogy, right? Everybody's got their AI pictures these days and they're like holding the dog and like there's all these shenanigans. Same thing in the syndicated world. Right, everybody's showing, hey, we're gonna double your money in 5 years, and you're gonna get 5-6% paid quarterly and cash flow, right? But the problem is like everybody's fudging their numbers to get to that projection, and that's fair and that's fine, and everybody's fudging their numbers. But when you're evaluating deals, and when we evaluate deals, what we want to do is we want to take all that fudge factor out, because some people are fudging it a lot more than others. one of the
Yeah.
biggest things that we teach is, taking a look at the reversion cap rate, which is that one cell on the spreadsheet that manipulates the total return the most. What that is, and sorry, this may be a little technical, but
Oh, go
what
ahead.
this is a number on the spreadsheet that says, hey, we think we're going to sell it in this type of market. Obviously, you want to be conservative and think that you're selling it into a weaker market in the future. Maybe pessimistic, but from a conservative underwriting point of view, that's what you want to do. That's the standard in the
Agreed.
industry.
That's how I
So
did it.
some of these operators, what they'll do is, the going in cap rate may be, 5, and they're assuming that they're selling it in a 4.5 exit cap rate market. So it could happen, but what we want to do is normalize it with other deals and underwrite them all to the same 5% or 5.5 reversion cap rate, just so you're comparing apples to apples. But yeah, a lot of deals that people look at that are meant for the retail investors that are kind of daisy chained out there, when you kind of underwrite it properly, it goes from like 125% down to like 60% return. It's like, yeah, let's chuck this deal.
I think for the young investor, for the new investor, if you're looking at a 2-family house, that's one thing. A single family house, that's one thing. I mean, you can get away with sometimes making mistakes, but when you're looking at multi-family units, 10 units, 10 doors, 20 doors, whatever. I think the important thing is to have, I mean, for me, for the people that I work with locally in my markets, in the state of New Jersey, and one of the things you really want to understand, and you can see this in the numbers as well, but not as much. But you'd really want to get down to I hate the phrase, but the nitty gritty of what the building is and its actual structure as well as its infrastructure and how it actually works. You got to, for me, and this is personal, right? I'm not talking about investing through the country. I'm talking about locally here. Is I want to be able to understand what things smells like, feels like, looks like, and that's how I'm going to do it with my experience. As time goes on, you're going to be able to do this through the eyes of someone else, through the eyes of what a number is, because you get the experience, which is kind of like what you have done as well. But you did it on a much more global scale, let's say, right? But what's really interesting about investing for the small time guy is really is to understand what it feels like, what it smells like, what it's going to need. And you're looking at the numbers and looking for that one number that's going to make the difference for you of where you might want to, divest yourself of that investment later on. As a smaller time investor with 10, 20 units, it's important to understand what it needs, where you can increase its value by fixing the needs, and how you're going to be able to increase the rents. Done that many times over. And it's just a basic of, just thinking about it and talking to the right people and getting the right opinions. When it comes to what you're doing, when it comes to the accredited investor, it's more numbers. Now, putting those two different things together, would you agree that it is that you can actually look at, are you able to look at a number? Here's my question. Are you able to look at a number, look at a spreadsheet of P&L and say, okay, well, here's an issue, there's an issue as far as what it might need in the future?
Yeah, but to your point, I mean, it comes from the experience of actually owning little rental properties and then, stepping up to a little bit bigger stuff from there.
Right.
And what you bring up is, I call it the kind of the two eyes, right? We all have two eyes. There are a lot of people that, get MBAs from East Coast schools that go to work in Wall Street and work for like CBRE or, Blackstone, all these hedge funds, and they run their real estate department. Incredibly smart people. They're spreadsheet junkies, but they rarely get on a plane and fly over to Alabama, right? And they lack that experience of actually owning and operating little rental property, which is actually harder to do, in my opinion, than these commercial assets, right? These commercial assets, I mean, the reason why we like apartments is cookie cutter. They're all the same. You just turn them and burn them, where the single family homes are so unique, and the margins are actually a lot smaller there. I mean, this is why we try to get over $10 million in value, because if you're under there, then you're competing with, all the smart guys like you, Dave, right? Like it's a very cutthroat and high competition kind of layer, where if you can get a little bit above that, and that's why you syndicate to get above that threshold, there's a little bit less fierce competition in that void.
Let's talk about the syndication. Let's talk about investing, being a partner with you. Let's say, I mean, you have, a $10 million project, a $20 million project, and you look for, investors throughout the country to invest with you. There's a lot of people out there that would rather invest in a REIT or invest in a syndication anywhere else in the country, where all they're doing is putting in their money and they're getting a dividend back, right? Is that something that makes sense to A, an accredited investor, B, a small time investor? And are there things to look out for when you do that?
Yeah, I mean, I think what I realized very early on when I had little rental properties is I was making a pretty nice return. And when I was comparing that with what I supposedly was getting in the 401k, I was like, why would anybody want to do this? But what was happening was, when I invest in the 401k or a REIT, you're investing through the secondary market, right? You're getting sloppy seconds. Everybody in Wall Street is taking theirs, heavy fees, hidden fees. Like, they're not doing this for free. Like, how else did they pay for these CEO salaries in these big buildings?
Right,
But
exactly.
when you are an investor yourself and operating, you're like, say, your little rental property,
Right,
you're accessing the investment from the primary source. I mean, that thing is yours, right? So this is the idea of like cutting out the middlemen in a way. Like another thing, for example, like IPOs and tech stocks, right? Like, everybody kind of waits until it goes IPO, and then that's when it's there for the masses, right? But
right.
there are ways to access these investments through more of a primary source, direct source, right? And that's kind of the idea. I guess that's idea number one, is like, cut out the middleman, right? Because then you as an investor get more of the spoils, right? The exposure. I think that's where syndications are kind of a nice. It's you're accessing the investment directly. Sure, there's a sponsor there, general partner, operator, but they're also doing all the heavy lifting. They're getting the debt in their own names, so you don't have to do that. And then the legal liability, they're a managing member, you are not. You're just an LP, a limited partner, limited liability there, which is why accredited investors like this. And then now they can go and diversify into many, many projects. Whereas if you're just operating your own little rental properties or portfolio, really you're only, you're stuck to one geographic area, which is absolutely not diversification. So that's kind of the idea, right? Like, yeah, you can invest in REITs, same thing we're investing in, right? Same type of buildings, but the
Right.
REIT structure just has a lot more infrastructure with other, layers of people, and then the certified financial planner world, right? Which I'm not a certified financial planner. I don't sell marketable securities.
So if there's okay, so someone's got, this might sound like a stupid question, but someone who's got $50,000 to $100,000 they want to invest in, but they don't want to buy their own little small 2-family, 4-family, whatever, and they want to invest in a syndication or something like that. Is there one that's better than the other? Is there something you should look at that's better than the other?
I mean, this is where it's all personal, right?
Right.
I mean, to me, yeah, if you're a non-accredited investor, you could probably find a 506B offering, but I that do take non-accredited investors. But in my opinion, and this is my opinion, like, I don't think that if you don't have a net worth of $1 million or greater, or make over $200,000 a year, I don't think you should be playing in these larger deals, because you're not gonna be able to invest that much.
Right. Right.
You need to be diversified, right? Like, I think this year I got like 80 plus K1s. Like, you want to get closer to that level, right? Eventually, right? But that's where, I was in that first floor of the wealth elevator from like 2007 to 2015. Like, it took me a long time. And that's what I write in my book, is like ways to kind of cut the learning cycles and the time
Right.
for you.
Right.
But this is not a skip to the third floor, fourth penthouse of the level of the wealth elevator idea. Like, a lot of people, there are a lot of people, gurus, saying, oh yeah, you can just go buy a 100-unit apartment complex. No, I'm also not the guy selling a guru program. to go buy an apartment or commercial property.
Exactly.
Like, I don't think you
Exactly.
can do that. I don't think you want to do that. If you want to go put all your chips on black in the casino, go ahead, right? But not advisable, right? Most people would say, don't do that. Just like if you want to go put all your money in Dogecoin, like, you can, but I wouldn't recommend it, right? That
Right.
said, I'm not giving anybody investment advice. All I'm
Right.
doing is like, hey, I can look back at the last couple of decades of me growing financially, and these, like, when I break it down, I just realize that there are these clear defining paradigms of the wealth building journey, and the strategies change when you're in them. So I would say the first thing to do is figure out where you're at, what floor of the wealth elevator you're at, what's your cattle grade, essentially, as they say in Texas. But it's like, don't do things that you're not ready for. And also, with some of the investors that we interact, like, they're still plugging away buying their fifth, sixth rental property. Like, I think after a few rental properties, you kind of check that box. You're good. You got enough experience. Move on to the next one
Right.
if you have enough
Right.
net worth.
Right. So, all right. So, one of the things that I really liked, that really drove me toward you, was I reading your bio online, and one of the things it says is, and this gets into your book and talks about what you really do, is you're annoyed by the bogus real estate education programs out there. The ones that take money from people who don't have it in the first place. You set out to make the free website that you have for other hardworking professionals, right? And I'm paraphrasing here, right? And you wanted to dispel the Wall Street dogma of traditional wealth building and offer an alternative to garbage investments in the 401k mutual funds that only make the insiders rich. You help the hardworking middle class build real asset portfolios, providing free investing, education, podcast network, plus access to investment opportunities not offered to the general public. I really like that, because there's a lot of people, as you know, and as you inferred there, that want to be in your pocket. They want to teach you all this stuff. There are a lot of really good information sources out there that are available, and it's tough to know the good from the bad or the right from the wrong. And I think it's really important. Like for you, you said yourself that you're not the guru teaching people how to do investments and stuff. But what you are, in my opinion, is you are a do-ru, where you actually do the work, do the stuff, and you've been able to go from that first floor all the way up to the wealth elevator. Talk to me a little bit about, as we go along, if someone's looking to get started in using the wealth elevator as the book as your base. What are the steps they need to take to get to a certain point of comfortability and moving forward and making more money?
Yeah, I would say pick up the book, figure out what floor you're at, and there's like a little chart if you've got like a short attention span in there to see where you're at, and maybe just skip to that chapter. But I think it's also nice to know like what happens after, right? Like you hit 2.5 million, 4 million, right? Like the mental shift kind of changes there and what you do. For some people out there that make over $200,000-$400,000 a year, you may have to just triage with taxes first, right? Because you're in those higher tax brackets. If you're under there, not a huge deal. But everybody's situation is different, right? If
Right.
you're an accredited investor, certainly would like to get on the phone with you and just talk and see kind of what you're working with. But I would say, going back to your earlier point of like, there's just so many BS programs out there, especially for the wholesaler, for the house flipper world, which I'm not in. I'm not in that world, but
You have no idea.
yeah, even like the commercial real estate stuff that's out there, like it's all the same stuff. It's all the same stuff regurgitated. Like the single family home stuff, like that's on my website too, because we used to kind of teach that stuff a long time ago too. But to me, the biggest thing that's helped me move forward is not the basic stuff, especially with AI these days. You can just ask it questions. You gotta be careful with that too. But the biggest thing is like community and getting around other people doing it. And especially when you're a accredited investor, right? Like I didn't know any accredited investor friends. My parents never owned rental properties, but my investing really took off once I started to interact with other purely passive accredited investors. So that's kind of what we kind of offer folks these days. We do our annual retreat in Hawaii, right? And because for me, having that aha moment of, wow, like I didn't realize that very quietly, these people invested, they had the same pedigree as me, a bunch of rental properties, and they're selling them off to go into these more syndicated deals. And like, well, where do you find these deals? Well, it's through your network, right? Because you absolutely never want to go to some online website or platform, because it's just some paid service from, that the
Right.
general partners are paying into. And then, at this point, what about all these other strategies, or, things outside of real estate too, right? Like I've kind of recently, especially with interest rates going sky high after 2022, I mean, no offense, Dave, but like, it's not your grandpa's real estate world
Oh no,
anymore.
it's not.
You can't just, you have to value add things, and you have to go into even places in flyover states with neutral to negative cash flow, and sometimes I question is if this is where we want to be. If you look at the everybody here should have the Chatham financial curve, who I think they recently, I checked them yesterday, they changed their website a little bit, so I don't know where the chart is nowadays, but the CME FedWatch tool, that's another one you should have bookmarked. Interest rates have a high correlation with real estate, that is. And the reason being is real estate doesn't move too much. That's why you have to magnify it with leverage. So that's why interest rates are very, very important. But yeah, when I got started, I was lucky, and when the grandpas and grandmas were doing it, they were super lucky too, because they were in a very low interest rate environment. And then the second part of that whole maybe false narrative, false thesis is like they assume that real estate prices always go up, or you're not necessarily seeing that in like kind of overbuilt places out there like Austin and I think Phoenix you got negative rent growth there, but I think long term it's great. But like, you're seeing some of the short term stuff in Florida, right, where they overbuilt a lot of this stuff. So yeah, I think that there's different asset classes out there, and equities, real estate, private, and the big one is private equity, right? Investing in businesses. But I think I got into this world with the real estate side, and now I'm realizing, and probably my next book will talk a little bit more about branching outside of the world of real estate. But I still think, if you're not a credit investor, a great way to get started is just, buy the little rental property.
So just one more thing, and it's going to be a selfish question, because it's something I've been thinking about as far as the building of luxury apartment buildings, which we see all over New Jersey. You see it like, for instance, I would, crazy as it may seem, drive to Florida and not fly, because I just simply like to do that. You see a lot of these luxury buildings going up, 3, 4, 5-story buildings, that really get higher rents, and they've got the amenities, but we see an awful lot of them being built. It's going crazy around here in Bergen County, where they're building hundreds and hundreds of units on small pieces of property. The preface to this is for the question. The question is, will there be a time where these luxury units, these luxury buildings being built, these luxury apartment rental buildings will be overbuilt, and there'll be a glut and they will devalue? Will we see that time in this country? Will we see that time in these buildings, no matter where they're being built?
Well, the geek in New York City already knows this. I mean, they can monitor supply and demand. I think this is where they have advantage over the average guy who's boots on the ground in whatever market. But I think generally speaking, there is a housing shortage overall, right? The problem now is there's just a lot of new things being built right now today. Why? Well, everybody and their mother, including us, right? We had developments that we built in the heyday of 0% feeding frenzy, 0% interest world. So what a lot of people did is they took advantage of that, and right up to like when the interest rates started to go up the summer of 2022, they kind of, that was the tail end of, I think the snake eating the crocodile, if you think about it like that.
Yep.
So a lot of these projects got started in 2023. And then now, it takes 2-3 years for a baby to be born in commercial real estate and then lease it up. So you're going to start to see a lot of that stuff go, that crocodile going through the snake. Now, in some of the markets out there, you've already seen this crest over. Places like Phoenix and Austin, it's probably going to be another year or two before that glut gets worked through. But nobody's really building from 2024 on, right? So you have this huge void. So what you're going to start to see happen is once, places like Phoenix and Austin, you're going to have negative rent growth for like another year, in my opinion, and maybe another year of neutrality. But after that, then the new supply is like dead, right? There's nothing coming online. And then your bigger trend will take over, right? Your undersupply trend. So at that point, the rents will probably take off at that point.
I just see it as a trend because what happened here in northern New Jersey is it's just so obvious with warehouse space. I mean, they were knocking down huge office buildings and building, 300,000-400,000 square foot warehouse buildings, which are sitting vacant, not being utilized, not being rented. So I look at that and I'm saying, okay, well, I call that the Amazon mistake because everybody thought everybody's going to need warehouse to go all these warehouse things. And I look at the apartment buildings being built. And I said this a few years ago when near where I was living, they were building like 500 units right on the train track. And I know a couple of people moved in and moved out the next month because they said the train was too loud. And I said to them, I said, what about the train tracks next to the building? Didn't you understand? Right. So, but that's more of a joke than anything else. But the point I'm making is I think there's going to be a time when this is going to happen. Anyway, I've gone on and on. I want to thank you so much, Lane, for being on today. We have Lane's contact information on the bottom, as well as the QR code here is for the book. Please go get the book. It's a great book. It really will take you through the steps of investing one step at a time. Lane, is there anything else you'd like to add to our conversation today before we?
Yeah, thanks for having me. And then, people pick up the book and they leave a review, take a screenshot, send it to team at thewealthelevator.com, and we will hook you up with the PDF version. So a lot of you people like to throw that into your LMMs and GPTs, get more personal questions from there. But we'll also give you the MP3 version. So in case you're like me and can't read too well, I'll read it to you. But yeah, thanks for having me, Dave. Really appreciate it.
I appreciate it, man. And two things to go. One's a question, one's a comment. First is, how do I help you grow your business?
Yeah, just send them to thewealthelevator.com.
There we go. And last but not least, Lane, everyone on the broadcast gets a hat. The Artie Skill Builder hat. We'll be sending this out to you. Hey, everybody, we've got special guest coming on. My friend, I'm glad to call him friend. His name is Leo Pareja. He is the CEO and president of eXp Realty. Some big things been happening. eXp just joined with Next Home and changed their ticker to AGNT from EXPI. We're going to talk about that. And, if you have any questions you'd like to ask Leo, please send them to me via DM. But anyway, Lane, thank you so much for coming on. Please stay on as we go off. Thank you so much, everybody. We'll see you next week for episode 418.